Hello, ladies and gentlemen, and welcome back. Well, all of us are now aware that interest rates are on the rise, and more importantly, the bond market is starting to freak out. We'll be taking a look at that bond market today, but of course, we need to talk about whether the Federal Reserve is going to raise rates by 75 basis points or 100. What the market is telling us is that it's ready to make a big move because we're at critical across stocks, commodities, and the world's biggest hedge being the US dollar. So many markets at key points. And on top of that, what just happened in yields with pretty much most of them now reaching all-time highs for the last several hundred days is pointing us towards some interesting potential drawdowns on these markets. Stay tuned as we cover it all off today. Well, welcome back everybody to the Daily Show where we talk about stocks, commodities, and cryptos. Let's begin by discussing yields and their breakout again. We've just had the percentage of US Treasury yields at 252-day highs go from less than 20% to 98%. And when we start to see these readings, some interesting statistics start to appear. Now, for anyone that's followed the stock market for long enough, you would know that around 59% of the time, you expect the stock market to be bullish. Now, of course, we're in a very unique period, high inflation, all sorts of concerns across the world. But when we've seen the bond market freak out like this and push yields to super high levels and really to make that random thrust zone, we have had some kangaroo style markets. That is, markets that were weaker in the future. 1, 2, 3, 4, into 6 months later, we were barely positive over that period. And that's kind of signaling that there could be more pain to come in these markets. Another thing is also sectors, rotation. Remember, big money, how do they have to invest? Well, they can't just all go in cash. They can't stay in cash for that longer period. So when we tend to see these readings, we also have a little bit of a flight to safer sectors. That's be something that we're looking at now over the next coming weeks, and especially after this FOMC event. Will the big players jump more into utilities, consumer staples, and defensive sectors across the board? That tends to be what they do before bad things happen. Cyclically adjusted PE ratios, how does that look? Well, again, if we have high yields, we have this change where it goes from negative or under 20 to 98% plus. We tend to see a compression in the PE ratios. And this is something that I think is very big when we're talking about the markets right now. On average, PE comes down quite significantly during this time as the markets revalue what stocks are worth. And if you look here at this S&P 500 PE ratio, the average is currently 19.48. But if we go to the mean and median, we really aren't anywhere near 15.98 and 14.9, which are those levels. Now, a lot of you will say, well, we can't use PE ratios during this time. We've got potentially a weakening economy. We've got, of course, companies probably earning less in the future. This is a bad number. What it's telling us, though, is that the market is potential valuation of all of these companies has to come down. And if that happens, then we could be seeing new lows in the market. And it's, one of those case scenarios that you must be thinking about. We do know that inflation is incredibly sticky right now. All these bonds markets, as we'll see later in today's video, as we go through the key charts, look at every levels that we need to look at the key zones that we want to see broken ahead of this FOMC or as it happens. We do know that generally 8 months from the last hike, that's when we get the first cut. And at the moment, we're seeing really rates basically peak at around 4.5% in the future during April of 2023. And the first cut's expected in October through to December of 2023. Will that eventuate? We'll find out. We've got these charts up all the time. Midterm election year is usually a bad year regardless. But of course, we're in September and October, the worst months of the year, generally on record throughout stock markets from 1931 to now. It's an interesting stat, well worth knowing if you haven't ever heard that. And of course, generally speaking, the back end of September is weaker than the front. We'll find out whether that holds true. It's just a little bit of a stat to add credence if you do see shorts in the market. Here's all the bear markets since the 1800s in terms of how long they've lasted for in their recoveries. Pause the video if you're interested there. And our standard discussion about how we always expected a double dip here, but will we get the most correlated market to the current market, which is basically, of course, 2008. At this stage, it seems to be almost playing the perfect kind of correlation to 2008. Will it be that bad? Time will tell. I tend to believe that we will find base before going into utter capitulation. That is, we might go down to 3,200 or 3,000 on the SPY, but I am certainly hoping that we don't get into those low 2,000s like many of you in the comment section have been posting to me recently. Midterm election years, we need to keep an open mind. While they go into the midterms week, that is often around that 10th to 15th of October, they tend to turn to the bull side. After midterm elections, the stats are actually very favorable for markets. So remember, if we go into capitulation here, you might want to think a little bit differently than others about markets. They do have a tendency to do very well afterwards. Every time is different, but of course it's there. And also remember that we have the CCP big vote that's coming up mid-October, and all of these other things that just too many people aren't discussing. The CCP vote in particular is going to be a big one. So subscribe, because we'll be covering off on that in the future. I think what happens there could really define how the entire world moves forward over the next couple of months. So just before we jump into the charts, I want to say a big thank you to, of course, Tiger Brokers, who are sponsoring today's video. We've just recently finished doing a whole bunch of some of my favorite features, but I did want to bring this one up again, which is of course the trade window. And more importantly, what I thought I'd do is let's take a little bit of a positional, just so you can see how easy it is to, of course, place trades within the Tiger Brokers platform. If we go over here, we can see that I've selected Telstra, which is an Australian-based company. The market's open at this time for this company. And you can see here that I can just press the buy button and it will come up with an order confirmation. I can select limit orders, I can select market orders, and of course I can select stops as well. So if I select market order, let's say I want to buy these particular stocks, I could then press the buy button, load it up. It will ask me to, of course, make sure I'm willing to do so. It will then confirm it, which is very important actually. A lot of platforms, sometimes they don't get you to confirm it. And then of course you can press the confirm button and this will place the order. And you'll notice that that's gone in. It's made a little kind of sound to say that the order's gone through, and we can then go over here and see whether we've filled. And we just filled then for this order at market. And of course, we've got it. So one of the reasons that I like this platform so much is not just because it was so easy to, of course, place a trade. There's an app that lets you do it. There's a whole bunch of community news. Remember, you can just go over to the news tab and see all of the information coming out here about all of the stocks. You can select watch list ones and put them in there if you wish to. And realistically, it's all at your fingertips. They're constantly improving, constantly adding new stuff. So if you're interested, and especially if you're from Australia and you're interested in getting the special offer of the extra zip stocks at this stage, you can look at the links in the description down below. And remember, the zip offer is only until September and the end of September. So don't delay there, guys, if you want to get those stocks. Thanks so much. Let's talk about VIX. Volatility Index was up slightly on the session ahead of the FOMC. Not really anywhere in particular. It's neither at a 35 nor is it at a 20. So that means that, of course, we're not really seeing a huge move there in volatility leading into this event. It's just kind of just hovering around that zone. Expect it, though, to spike, especially if the FOMC freaks out the market. Yields are where the story's been this week. 4.5%, a 4.5 handle here when it comes to, of course, the April figures for yields. We know the 2-year is sitting at almost 4%. Incredible stuff. The 10-year at 3.5%, which is moving up quite significantly. New high here for this, giving us credence into those stats. And really the first cuts are not expected until October into December now by the bonds market. Could be a bit of rough times ahead. A lot of people out there do not have any idea. Remember, you guys might, but most people out there, the general consumer, has no idea about what interest rates are coming from on the horizon should all of this eventuate. Let's look at the US dollar. It continues to hover around our resistance zone, 110.25. You'll notice at the time of recording, it's having a little go at trying to get higher, but this resistance, this supply area up here has held the whole time. We talked about this 109 kind of 20 to 40 zone. That's where we found the buyers back for the US dollar. And remember, the trend here is still currently towards the US dollar up. If it starts to hold above this 110.25, we've got to be careful and really watch out down below for the S&P 500, because strong dollar, that's been coinciding with, of course, weakness in the S&P 500, Nasdaq, and others. This will be the chart to certainly have on your screen during the announcement to see how it closes. Stay tuned for the next video as well on that. Same with the euro. You can see it's taken that high there, grabbed some liquidity, certainly instantly sold back off, and now it's making a series of lower highs. I mean, if you were looking at this and you weren't even paying attention to what's probably going to happen here when it comes to the news result, you would think, well, this looks pretty weak and it looks like it wants to just absolutely get pummeled. And time will tell whether that does occur, but series of lower highs and straight into there with a take. It's looking like some nasty distribution at this stage, which is going towards that weakness. And of course, that's what the market is kind of painting the picture of. Gold's very similar. It's holding that 1660, its last defensive point. If it gets through and breaks below this and closes below this, we've got to be very careful with gold because there's not much holding it up until we get back down into these 1500s and 80s or even 1461. And I hate to say it, but gold doesn't like this type of, runaway inflation. It doesn't tend to do well with raising rates. There's a whole bunch of reasons why. Commodities also, if you check out our previous video that we did, we talked about the stats there. Commodities weakened for the future as well at this stage based on the stats that we're seeing. So a bit of demand destruction, a bit of problems here. Will gold hold? We'll find out very soon. Natural gas, a lot of people wanted me to message on this one. Well, it looks like it's kind of weakening off here, but again, look at that, right on the demand. And it's holding as best it can ahead of the news. Expect that to be explosive in terms of moves. We also see US oil holding around its most important zone, the previous weekly highs over here, and our current structural base. Will it break through 89, 90 and actually give us some good trading opportunities, or is it just going to go down all the way downtown into this 65 over the next coming months? Well, we'll see. Next 24 hours will tell us a lot about these trades. Tesla's at resistance, a key level ahead of key news. No surprises there. I've said this for a few days. At this point, it's kind of critical. Having risk management is key here because you're at a key resistance. Most likely, if it breaks, what's the worst? It generally will come down and retest later on, giving you the opportunity to get in and then react to that. And if you have the patience, you often do get the better opportunities, or at least you get the higher reward opportunities without taking super risk. At the resistance, I think the risk here is still to the downside on something like a Tesla. Apple, it's pretty strong. I mean, it ended up having a decent session, but I have a feeling a whole bunch of this has got to do with how many people are trying to short Apple right now. There's a lot of shorted stocks that are starting to buy up, and I think that's because so many people are piling into the short. It's being a crowded trade. If you look at things like Google, I mean, that's the one that we're possibly seeing a drop. What if it goes underneath this 100 marker, gets into the 99s, and then just bounces straight up? That could be a very interesting trade for people that really have their set mindset of knowing how to pick these types of positions. But if it falls through and closes, watch out down below, because there's nothing much that's going to hold Google until possibly into these 88s. We've already seen what's happened with Meta, Facebook, almost at the 2020 lows, another critical zone potentially coming for this. And it looks like the market wants these levels. How it gets there, though, is the guess that we're trying to form, or at least form this concept in the markets. And it's very difficult ahead of so many big economic bits of news. The bonds market coming into the announcement, it's not happy. You can see here, high yield bonds freaking out, getting upset about the world and starting to drop down. Pretty important. Obviously, we need to focus in on something like high yield bonds. If it makes a new low, this will be a big 24 hours. If that does occur, we've got to then, I'll give you some updates on my lead bond indicators. If they all make new lows as well, then we kind of can really start to discern that maybe there is new lows potentially coming here for the stock markets around the world. The DAX, new low formed. However, it's not under our critical sup yet. And if you go out to the daily, you'll see what we're talking about. Previous buying demand zones that have come through. We have not seen that tested yet. So this will be something that we're watching through the next 24 hours. You just got so many of these positions at criticals. Here is the Nasdaq. Now, notice it's in the middle of both ranges. We've got our critical demand, our critical supply or resistances, and our major ones. I could see this spike one of these zones and then reverse it, whichever one it wants to. Often with these decisions, especially when they're statements and they come out, the market will go in one direction to trap liquidity, to trap us as traders into a position. It will then reverse those positions after going through that zone. Now, if you know how to spot it and you're looking for it and you have your proper risk management, that's really the way you have to trade news. You have to look at extreme points, and when extreme points are taken and reversed, then you can say, I see what you're doing. But you've got to be careful around this news. In the middle of nowhere land for the Nasdaq. And as you'll see when we use the S&P 500 here, it's the same for this one. It's finding as best it can support. If you were looking at it, you would think, this has just hit a critical zone, rejected from it, probably extracted a whole bunch of shorts ahead of the FOMC. So you would think, probably it's going up. That's actually what's happened a lot of the time since this FOMC statements have come out. We've seen that bullish pressure. I'm open to both though, and that's the problem. You've got to also think, where's the extreme buy zones here for the market? It's more likely in this box down here, that 37.50 to 37.20 zone. This is critical for these markets. If markets get into this zone, well, of course, I would expect some buyers to hopefully pick up demand here. You're looking for structure, smaller time frames, and again, practicing the patience. Let's look at the futures market. 39.60. Key supply, big level there moving forward. We've got this miniature one. We talked about it. That was the first short. I would have preferred to take that with options. I discussed it in the previous video, and I totally see why people may have taken that one. I do tend to like to wait for the perfect entry zones, the critical zones, but of course this is a big thing, and that's something that I guess, that's just the way you type to trade. If you're prepared to leave some, that's good. If you're prepared to take, let's say, the more aggressive entries, which was here, then what instrument do you pick to take? That's very important. The market came down and it cleared these lows and rebounded near the end of the day. Again, could critically hit that, move up, could also take the high, move down. It's going to be the first reaction, I would think, is probably going to be wrong unless the Fed come out and say something crazy. I doubt they will. But the market's setting up for some sneaky trapping over the next 24 hours. And I look forward to making the video over the next day to get on that and have a talk about it. Same thing for Bitcoin. I won't mention this too much. Look at our previous video. I've still got a plan that I believe Bitcoin can get lower. In fact, I'm thinking between that 9 and 12,000 in terms of my personal opinion on where technical levels are. And of course, there's a kind of halving cycle concept that would mean that in the next 150 days, I know that's wide, we would see the low formed on Bitcoin. So I'd like to see further weakness sometime over the next few months and actually push lower. You have to be patient and confident in your abilities if you're going to be an investor in these types of things. And of course, at this stage, we can see that it keeps making a series of lower highs. The market is really going to dictate it. And realistically, Bitcoin is a lot weaker than the stock market right now from just a price action standpoint. You can see it on these charts. If you haven't already, come and follow us at FX Evolution on Twitter if you're interested in following along. And do remember, the FOMC statement is at 2 p.m. New York time. That is a 75 basis point expectation. About 20-something% of economists think that it could be 100%. I'm not too sure whether we're going to get that 1% kind of raise in rates. We'll find out. Obviously, the press conference after that half an hour, that's often where you get that kind of reversal where they have the initial rate, the market goes a direction, and the FOMC press conference, that creates even more shenanigans. We still have monetary policy statement for the Japanese yen. And what's going on there? We've got the Swiss franc. We've got the Bank of England. It doesn't get bigger than monetary policy. And this is the year of data-driven, realistically central banks. If you haven't already checked out Tiger Brokers, definitely consider doing so. They've got a whole bunch of special offers right now. And of course, at the end of September, for Australian viewers out there, their extra bonus SIP shares will run out. So if you're interested in finding out more about Tiger Brokers, look at the description down below, look at the little links, and of course, you can check it out whether it's right for you. Thanks so much for watching, guys. Subscribe, comment, like it, and we'll see you in the next one. Bye for now.